Welcome to Quilter Cheviot's Markets Uncut podcast, your weekly insight into the topics and trends that we have been exploring for you here at Quilter Cheviot. Remember, so you don't miss future episodes, be sure to hit the follow button on whichever streaming platform you're listening to, or by following hashtag QC Weekly Comment on LinkedIn. I'm your host, Maria Gardner, Investment Director at Quilter Cheviot International in Jersey. And this week, I'm pleased to be joined by Tim Armitage, our investment strategist, and Maurizio Carulli, our commodities specialist. Good morning to you both. It's certainly been an interesting year so far. Despite ongoing geopolitical tensions, conflicts in various regions, and continued uncertainty around the global economy, major equity markets went on to reach fresh all-time highs during June. And at the same time, we've seen some fascinating moves in commodity markets, particularly gold. So today we're going to explore what's driving investor confidence, how we think about risk, and what the outlook might be for key commodities as we move through the rest of the year. So given everything that's happening in the world, Tim, why do you think markets continue to look through so much of the noise?
Well, there certainly is a lot going on, isn't there? But hey, isn't there always? You are right, though. The markets, for the most part, do seem to have been able to look through the geopolitical noise and concentrate on largely two things. So a robust macroeconomic backdrop and a positive outlook for earnings growth. So in terms of geopolitics and wars in particular, I think what we've seen this year is actually quite a typical market response. We saw an initial sell-off at the start of the conflict in Iran at the end of February, and that was largely because the range of potential outcomes widened out significantly, and there was a larger likelihood of there being a negative shock. But as investors started to price out the likelihood of a recession over the next 12 months, then that range of outcomes or potential outcomes narrows, and investors have more likelihood of a positive outcome. I think energy security has been a big theme and will continue to be a big theme going forwards. But certain economies have become more resilient and are less exposed to commodity price shocks in places like the Middle East.
Yeah, absolutely. And it sounds like you do, but so you think markets deserve to be trading at these levels, and you think that investor confidence is justified?
Yeah, I think where we likely are in the economic cycle, so mid to late cycle, I would say, then I think investor confidence is broadly justified. Yes. So earnings revisions have been so strong so far this year that actually equity valuations, so things like forward-looking price to earnings ratios, have actually fallen, and that's despite stock prices also increasing. So as I mentioned before, so macro data, things like manufacturing and services indices, the level of unemployment, those types of indicators have been quite resilient. And we've only seen a modest fall in growth expectations, and also inflation expectations that have been reasonably well grounded, well anchored.
Yeah, thank you, Tim. And sort of moving on slightly, some commentators have started to describe artificial intelligence as the beginning of a fourth industrial revolution. How important is this theme in supporting markets today?
Yeah, I mean, it clearly is very important. We're talking about potentially a technology that could reshape many aspects of our lives, from how we communicate with each other to how we work. And I think what began with a massive investment commitment by the large US hyperscalers, that's really translated into huge potential earnings for semiconductor and memory producers, both in the US and also in Asia. I think where there is a concern is that we're yet to see significant productivity gains from the end consumers of AI products. And so there is a risk there that we don't see those materialize to a great enough degree to justify all of that investment. But we're not there yet. And I think for the most part, confidence is justified. And there's been lots of talks about us being potentially in a bubble. I think we're certainly not in a price bubble, but we are potentially in an earnings bubble of sorts, I think.
And on the topic of bubbles and things that we see in the news, I think one of the challenges for investors is separating sort of genuine long-term risks from daily headlines that dominate the news cycle. As our investment strategist, how do you go about assessing risks?
That's a great question. So I'm a former investment risk manager at one of the world's largest asset managers. So I spent a lot of my career so far thinking about kind of broad market risks yeah, it's something that I take very seriously and have tried to sort of work on while I've been at Quilter Cheviot. So I like a data-driven approach. I think using a mix of risk indicators, so things like market volatility and concentration. Concentration is a really important one because it can build up gradually over time and isn't necessarily easy to observe. But once you have a market that is sort of highly concentrated in a few drivers, then when you do get a market shock, then that can be more severe than otherwise. So I've been introducing various different indicators, but also we do use scenario analysis and kind of regime analysis quite a lot in our investment approach. So trying to determine whether or not growth or inflation is the key driver of correlations between equities and bonds, for example, and then also trying to have a broad view across a range of scenarios and assigning likelihoods and probabilities to those scenarios. All of that is really trying to lead our asset allocation committee and other investment committees to avoid behavioral pitfalls. Things like recency bias, for example, that really means just overemphasizing recent information in relation to or relative to kind of broader, longer term risks.
And from what you've seen and from those indicators, so qualitative and quantitative, as we move into the second half of the year, for everybody listening, what would you identify as the 2 or 3, say, biggest risks investors should be paying attention to?
Sure. Well, I mean, there are 2 reasonably obvious ones, I think, to start with. So clearly, a resumption of the conflict in the Middle East is a concern. I do think the market should continue to look through that, though. But I'm sure Maurizio will add more detail to this going forwards. But there is the concern that oil prices may spike again. We've seen quite a lot of a backstop from the likes of the US and China using their strategic reserves, and that may not necessarily continue. But yeah, so central banks have so far been able to look through that noise and avoid significant rate hikes. But I think if we do see a renewed increase in inflation expectations, then central banks might be forced into further hikes, and that's always got the potential to stifle economic growth. The second main risk, I think, is our sign, and we alluded to this earlier, but signs of weakness in AI-related earnings growth. Yeah, and I think given how reliant the equity markets have been on that theme, I think that is also a key risk. One that's potentially less spoken about, but I would imagine will become a greater theme, is around environmental concerns. We're likely to experience a super El Nino weather cycle this year and into next year. That could really be quite devastating for global harvests, and that could potentially have quite a significant impact on food prices and therefore inflation. We're all experiencing the current heat waves, and I think this is potentially just the start of some of the weather-related risks that we're seeing.
Absolutely. I mean, we saw it at the weekend. It was incredibly, incredibly hot. Just sort of finishing on a question, Tim, of if listeners remember just one thing from our discussion about markets and risk, what would you like that to be?
Try not to overreact to every headline you see. I think that would probably be it. That those headlines are intended to grab our attention, obviously to provoke a response. But we've alluded to the idea of noise quite a lot so far. What we read on a daily basis mostly is noise. Broadly speaking, and zooming out, a little bit. The global economy is in good shape. We may not get another year of quite the bumper equity returns that we saw over the last 12 months, but well-diversified portfolios should continue to perform well and as intended.
That's a really helpful way to frame it, Tim. Thank you very much. Now we're going to turn from broader financial markets to commodities, because whilst equities have captured a lot of the attention in recent years, commodities have had a fascinating story of their own. And gold, which the listeners you will have heard in the headlines as well, has been one of the standout performers, and investors continue to ask whether there's further to go. Maurizio, welcome. Gold has been one of the best performing major asset classes over the last few years. What have been the key drivers behind gold's rise, and why has it resonated so strongly with investors?
Very good question, Maria. Now, the strength of the price of gold in recent years has been determined by a number of factors, and there are six which are the main ones. The first one is the geopolitical tensions. So, for example, the war in Ukraine, the war in Iran, and so forth. The second was in the past, the interest rate cuts, because gold does not yield any interest, so decreasing interest rates make it more attractive in relative terms. The third factor, a particularly important one, has been strong purchases by central banks in an effort to diversify their reserves, and as well as purchases by private investors aimed at long-term capital preservation, either in the forms of gold bars or of jewelry. The fourth factor has been the positive inflows in gold-backed ETFs. And also, as a fifth factor, I would mention the more or less fixed mining supply of the metal, combined, of course, with growing demand. And last but not least, the sixth factor, the particularly high levels of public debt across the world and the consequent perceived fiscal risk. About the second part of your question, i.e., why has gold resonated so strongly with investors? I mean, in part, of course, is for the six factors that I mentioned before, but in part because gold is a physical asset and therefore has also been across millennia in the human history inserted in the psyche of individuals as an instrument for capital preservation, and therefore that has been an additional element of importance for investors, of course.
Of course, thank you. And to sort of turn that on its head, more recently we've seen gold come off its highs. What drove that move? What's been driving that move?
Yes, I mean, there has been a number also here, in this case, a number of I would call short-term factors. The first one, there has been less buying from central banks and ETFs. Yeah. There has been also some what I would call the market tiredness after a stellar performance in recent years. There is at the moment also the expectation of interest rates rises again, and as I mentioned earlier, that do not bode well with the short-term performance of gold. And also there has been some temporary selling by emerging markets, central banks and financial operators, since gold is a liquid asset and in moments of need it is one of the first to go, like for example the current Iran wars, because gold is can easily become a source of liquidity.
Of course, and in today's environment, so given everything that you've said, and particularly, we hear some people calling gold now a risk asset. What role do you think gold should play within a diversified investment portfolio?
Yes, that is a very important question. Gold has certainly a role in strategic asset allocation, but given the extreme volatility of its price, there is also a need to take into account tactical considerations. So until the US dollar will be strengthening and interest rates are expected to rise, it is probably unlikely that gold will perform particularly well.
And moving on slightly from gold, another commodity that continues to attract attention is copper. How significant is the AI theme for copper demand? And do you think investors fully appreciate how much physical infrastructure sits behind the AI revolution?
Yes, I mean, certainly copper is a key metal, not only for AI, I would like to stress, but also for the energy transition theme as a whole, i.e. the fact that there is progressively more electrification of the world energy system. And this requires, of course, additional demand from copper, because you have infrastructure like copper cables to transmit the electricity and distribute the electricity. You have more copper wiring in houses. You have copper wiring in products, in final product like EV cars or computers or any kind of technological equipment. So it is not only AI which drives the demand for copper, but is a more general transformation in the economy and sort of how say industrial revolution, if you want, through more electrification. But AI is an additional positive factor. I would not consider the main one, however. I think the main one is again the energy transition, because AI will require more copper cables inside the data centers and hyperscaler plants. But in terms of additional requirement for energy transmission, most of the hyperscalers and the data centers providers are building sites with have a sort of a localized production of electricity, either with renewable or with gas-fired power plants. So the demand for extra transmission cables is more due to the energy transition rather than the AI revolution.
Absolutely. So demand for copper is absolutely growing. It's coming from different directions. But of course, we know demand is only one side of the equation. Are we heading towards a world where copper demand grows faster than new supply can be brought online? And if so, what does that mean for prices?
Yes, it is a likely event, very likely event, because on one side, certainly demand for copper is going to increase. There is no doubt about that. But on the other side, it is quite difficult to make new discoveries of deposits of copper because of geological scarcity, if you want. And also it is even more difficult to develop a copper mine once a copper deposit has been discovered due to engineering challenges and frankly the complexity of obtaining mining permits. I mean, there are some copper deposits around the world where the companies trying to develop those deposits have been asking for obtaining full mining permits, sometimes for decades. And so there is certainly a problem of future supply. And on top of that, there is what I would call an ongoing copper supply problem. Copper mines are complex and have often in very remote and challenging environments. And so they tend to be prone to problems, engineering problems, or to natural disasters, like when you have a landslide that block the mining of a copper deposit, like it happened with the largest copper mine in the world, called Grasberg, in Indonesia past year, and they're still the operator is still trying to go back to production because they suffered a natural disaster, and as a consequence, production had to be stopped.
Absolutely, and of course, if there does become an issue with copper production, is there another option? What other commodities are you sort of excited about, and where could the demand end up growing?
Now, in terms of substitute for copper, the only substitute, and only for a limited amount of usage, is aluminium. But I would say copper is needed in the world, and therefore, if there will be, as many people think, including myself, an continued increase in demand, and with challenges on the supply side, probably the copper price will rise over time further. In terms of other commodities of interest, I would say the most attractive one probably it is copper. Short term, given the crisis that there is in the Middle East, the Iranian war, and the elevated oil and gas prices, it is very likely that thermal coal will see an increase in demand, particularly in Asia, for the production of electricity, and therefore may benefit from the current short-term situation in terms of oil prices. Not necessarily that will be a very long-term thing, but at least in the short term, I think pressures on thermal coal prices will exist, and Asian countries which have a large availability of coal and also has a propensity to use coal for electricity production, despite the environmental concerns that we have here in Europe, will likely drive some sustained prices in thermal coal as well.
Thank you, Maurizio. So you've given us some really interesting points. But I'll ask you the same question that I asked Tim, which is, what one key message would you like our listeners to go away from our conversation with?
Yes, and that commodities are a complicated asset class exposed to significant price swings, and therefore, before investing in those, do seek professional advice.
That's great advice. Thank you so much. And thank you to both of you for those really good insights. And thank you everyone for listening today. So we've explored why markets continue to remain resilient despite an uncertain backdrop, how professional investors should be thinking about risk, and the role that commodities such as gold and copper may play in portfolios going forward. Did you enjoy our discussion on the podcast today? We'd love to hear from you. So please review the show now, wherever you're listening, and share it on your socials and tag us at Quilter Cheviot. And to make sure you don't miss a future episode, please tap the subscribe button, and we will be back next week. In the meantime, head over to our website, www.quiltercheviot.com, where you can read the accompanying market overview, as well as subscribe to our weekly comment newsletter. You can also stay up to date with our thoughts on market news, industry insights, and our upcoming events and webinars on our website or on our social media pages. And finally, if you have any questions you'd like to ask one of our experts for our next podcast, simply ask them via the weekly comments page on our website. We'd love to hear from you. And also, it makes it more interesting for us and for you as well. That's it for today. So thank you again. Thank you very much, Tim. And thank you, Maurizio, for your time. And to all of you for listening. See you next time.
This podcast is marketing material, not investment advice or research material. Investments can go up as well as down, and past performance isn't a guide to the future.